Ladies and gentlemen, please welcome Avi Gilburt, founder of ElliottWaveTrader.net. Avi is an Elliott Wave market analyst and author of ElliottWaveTrader.net, a live trading room featuring analysis by him and a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch, Forbes, and Seeking Alpha. Avi, thank you so much for being here today.
Thank you so much for having me.
You're welcome. The floor is yours.
Thank you. Well, good morning, everybody. And thank you for joining us this morning. I'm going to go through my general perspective of where I see, well, where we've come from, where I see us going for the rest of the year, excuse me, and then where I see us heading over the next several years, potentially even over the next decade. Now, I always take questions at the end of my presentation. In fact, I leave plenty of time for questions. So my presentation is usually not going to take the full amount of the 40 minutes that I have allotted. We will probably go, I'll probably jabber on for about 20 minutes, 25 minutes, and we'll leave the last 15 minutes or so for questions. So I'll encourage questions, but I'm not going to be answering questions until we get to the end. So I hope you don't mind. Now let's move into this. Now, for those of you that may or may not know what an Elliottician is, let me just briefly describe what we do. My perspective on markets is very different than most, and those that have read me through the years may have finally figured that out. But I view the market as being driven by market sentiment. Meaning, when markets, when you have everybody into the market like you do at major highs, then the market has nowhere to go but down. When you have everybody having sold the market as you do at major lows, well, you have no more lower to go, and there's only one other place the market can go, and it turns up. And these are, normally you see these happening at the major extremes in the market. But what about, in the middle of the market, when you're not hitting extremes, how are we able to identify where the twists and turns occur in the market? Well, believe it or not, it's through a mathematical basis of analysis. The person who created the methodology that we utilize, his name was Ralph Nelson Elliott, and he identified certain things about the market back in the 1930s. So almost 100 years from the point at which this was first identified. What Elliott basically identified is that the market moves in a specific type of pattern. The market is generally fractal in nature, meaning it's self-similar at various degrees of trend. What do I mean by that? Well, first, let's take the perspective that Elliott identified that the market moves 5 waves within a primary trend and then 3 waves within a corrective trend. So what I've got up on the screen right now is just a very simplified Elliott wave structure. And as you can see, we have, wave 1, you have wave 2, followed by wave 3, 4, and 5. And those are the bigger Roman numerals. Now, within wave 3, and this also applies in every part of the substructure. So you have labeled wave 3, 1, 2, 3, 4, and 5. Because like I said, if the market is fractal in nature, then each of the subwaves divide up in the same way as the larger degree. And you can continue to move out in time or continue to move in time. And they generally will be self-similar at all degrees of trend. If you notice, I don't have it labeled, but the Roman numeral wave 1 also has 5 waves up. And then it's not labeled again, but the Roman numeral 5 also has 5 waves up. So, and that is within the larger 5-wave structure. If you also take note, waves 2 and 4 are corrective in nature, and they have 3 waves. Each, if you again look closely, wave 2 has 1, 2, 3 waves down. Wave 4 has 1, 2, 3 waves down. This is the general framework that Elliott provided us about the market. Of course, there's going to be a lot of variance within this, but this is the general structure that we work with. What we've done as our contribution to the Elliott wave theory is that, up until this point, the biggest concern that people had and biggest issue that people had about following Elliott wave analysis is that it's too subjective. There are too many ways an analyst can come up with an Elliott wave structure. And I'll be honest with you, I completely agree with that, because up until the point we created something called Fibonacci pinball, there really was no objective framework within which analysts and Elliott wave analysts can come up with a reasonably accurate wave structure. Rather, many really would look at this and say, that looks like 5 waves up. That looks like 3 waves. A lot of it was based upon look. But if you actually take apart what it looks like and apply mathematical proportions to each and every wave structure within the larger degree structure, you usually can come up with a very high probability wave count that will give you some strong warning signs about when the market is going to turn, and sometimes, really depending on the degree, turn in a very big way. So let me take a step back and explain to you, how we look at this from the larger degree perspective. And as you can see, this is a 100-year chart of the S&P 500, and it's broken down within the larger degree wave structure we've been tracking. Now, to give you some idea of the power of Elliott wave, back down here in the 1930s, Elliott was calling for a setup that was going to provide us with a 70+ year bull market. Now, for those that know their history, Elliott provided us, I think it was in 1941 or 42, with this expectation that the market was about to embark on a 70+ year bull market. That was during World War II. World War II was raging around Ralph Nelson Elliott at the time, and he called for a 70-year+ bull market. To me, that was the best call I have ever seen from anybody in my lifetime or any lifetime. I have never seen a market call to that extent. And this is the power of what Ralph Nelson Elliott has given to us through his observations of the market many, many moons ago. Now, in standing on the shoulders of such giants, we can now take what Elliott provided us and build upon it to see, where are we headed in the next 20, 30, 40 years even, maybe even longer. So allow me to just go through this in a very general term, and I will focus a little further in on it. We'll start moving into it from time frame perspectives. We'll go from this 100-year chart. I'll then move into my monthly chart, and then we'll move into a 60-minute chart to give you a better idea of where I think we're going for the rest of this year.
Excuse me, Avi.
Yes.
Do you have a pointer, or are you using your mouse? I know that the audience would welcome to be able to see it a little bit better if you do.
Unfortunately, I do not have a pointer. I'll use my mouse. I don't know if you could see this. It's a little faint.
It is a little bit faint, but I am seeing some movement. So if anything, that's a
I
little
will
bit
try
better.
and use, thank you. I will try and use this, but I do not have a pointer. I apologize. So I'm going to start with Roman numeral paren 1 down here, folks. Okay, where you see Wall Street crash of 1929. That provided us, now remember, we said Elliott gave us a 5-wave structure that we tracked. So I'm going to be focusing on the larger degree wave structure. The paren Roman numerals are what we're going to be tracking right now. Okay, so you have Roman numeral 1 down here, right before the 29 crash. The 29 crash is what gave us Roman numeral 2. Let's go all the way up to where we are today. We're looking to complete Roman numeral 3. Now, I'm not saying that's today, but my expectation is over the next several years, my expectation is going to be that we are going to complete that Roman numeral 3 and then enter into a multi-year, if not multi-decade, wave 4 bear market. So that is my larger degree expectation. And that is all based upon building on what Elliott provided us many, many years ago, and taking it to where we see the market as of today. Let me take a step back and we'll move into the monthly chart, and you'll see my pointer a lot easier on this. This is our monthly chart right now. Okay. Just to give you some idea of where we stand, this is that same Roman numeral 3 topping that I showed you, the Roman numeral 3 paren topping that I showed you on that 100-year chart. Now, wave 4, remember, each degree divides up into 5 waves. So whereas Roman numeral 4 within the wave 3 paren was a long-term correction that took us from the top in 2000, and it was basically a sideways market for almost a decade. And it completed in March of 2009. We all remember that financial crisis quite well. At least anybody who's over 30 years old will likely remember it quite well. Now, off of that bottoming in 2009, I was looking for a large degree 5-wave structure to complete that Roman numeral 5, which would be the 5th wave completing Roman numeral 3 paren from the 100-year chart. So I was looking for a 5-wave structure off of this wave 4. And as you can see, the market has filled it in quite nicely. Now, back
Avi,
here, yes.
I apologize to break in again. I don't believe your chart has changed.
You don't see my monthly S&P 500 chart?
Is it the 100-year SPX?
No, not that one.
That's what we're on right now. It's not changed.
Oh, why is that? Let me see. Maybe if I just close it.
Yeah, that's probably the good thing to do now. Let's reshare it.
Okay.
And see what's going on.
Try that again. How about now?
1 second. There you go. Yep.
Okay.
I will keep an eye on it, and I'm sorry, let you know if that's happening. Okay.
Not a problem. Thank you so much.
You're welcome.
But basically, let me just restate. We had a very large degree wave 4. It took us 10 years sideways action, and it bottomed in March 2009, and we started this bull market run that we're in now. I am looking to complete this wave 5. This is that 4 paren, and complete wave 5 paren of that larger wave 3 paren that you saw on the 100-year chart. Remember, after a 4th wave, I'm looking for a 5th wave, and that 5th wave divides up into 5 waves as well. Remember, the fractal nature of the market explains to us that the market breaks down in self-similar structures at every degree of trend. So now that we are looking at, we've gone from that 100-degree chart, 100-year chart down into the monthly chart, I'm looking for this 5 waves to complete here. If now within that 5 waves, if you remember, we had a quote unquote market crash back in March of 2020. That was this right here. I had this box on my chart for a target pullback since we were here. I was looking ideally for the market to retrace back to the 2200 region to then begin a rally from the 2200 region to 4,000 plus, with my ideal target being 6,000 on the S&P 500. As we see now, that is pretty much where we stand. Now, whereas many thought I was absolutely crazy to maintain such expectation, I will tell you that I've done more analysis of market analysis methodologies than I can ever explain to you. And the Elliott wave system is the only one that I have seen that has been able to provide market context in a way that no other methodology that I've ever seen has. When we were dropping down here in March of 2020, I read one article after another, one analysis after another, explaining to us we have now begun a major bear market. My analysis was telling me that no, we're actually completing a quote unquote bear market move with this decline and about to resume the bull trend. To me, it was not the start of a bull market. Rather, it was a reset of the market to then transfer us into another bull trend. And that is exactly what we've been seeing. So ultimately, I am now looking for the market to complete a 5-wave structure off of this wave 4. So I'm looking for waves 1, 2, 3, 4, and 5 to complete a 5th wave of a 5th wave of a 5th wave in that larger degree paren 3. In other words, we are now coming to the culmination of a massive bull market move that actually began around the time of World War II. And that is where our larger degree expectations reside. So if I may, I'll just give you the bigger picture before I go into the smaller degree picture. If we are correct in our expectations here, then once this 5-wave structure completes over the next several years, again, my ideal target is the 6,000 region. We can exceed the 6,000 region for sure, but I'm just going to be tracking the structure, which will tell me more so than anything else when we complete. For now, my ideal target is still 6,000. But once we complete this 5-wave structure, as I've mentioned to you, the market moves in 5 waves up, 3 waves down. Once we complete this 5 waves up, I'm looking for a larger degree, 3 waves down. And, there are a number of things that suggest where the target for that next larger 3 waves down reside. The ideal target seems to be somewhere around 1,000 S&P. I know that is very hard to stomach, and I'll be honest with you, it scares the daylights out of me, because what this could mean for society in general is actually quite scary. Where you could see a market go from 6,000 down to 1,000. That is a very scary concept to consider. Do I think it's going to happen overnight? I do not. There is a theory of alternation that Elliott provided to us, which basically says if the wave 2 of a structure, is fast and deep, then the wave 4 will likely be a very a grinding, slow type of process that will take us a relatively long time. Whereas the wave 2 that took us into the Great Depression was very fast. It was a market crash. It did not last longer than a couple of years. That tells me that, at least it gives me clues that the wave 4 relative to that wave 2 degree is going to take us a very long time. That's why my expectation is this could be a multi-decade bear market that we could be heading into. Now, of course, when we deal with markets, there's nothing definitive in markets. Elliott Wave analyzes markets based upon probabilities. So we look for the most probable scenario. The most probable scenario still, to me, is this larger degree 4th wave. And again, it scares the crap out of me. But in the lesser likely scenario, I still expect, because we're completing a large degree 5-wave structure. So in the most bullish case scenario that I have, after completing this 5-wave structure off the March 2009, the most bullish scenario to me is still a retrace back to the 1800 to 2200 region. And to me, believe it or not, that's the most bullish case scenario. So for me, I know that once we complete this 5-wave structure, I personally will be cashing out of the stock market. I will be cashing myself out. I'll be cashing my family out. minimally, I'm expecting a return back to the 1800 to 2200 region. That's our bigger perspective. But again, that's going to take some time. That will not happen overnight. I think it's going to be a very, very slow and methodical, painful type of correction. I don't think it's going to be like what we saw in March of 2020, although I do expect periods of time where we will see large drops of that type of magnitude, but it will be within a much larger corrective structure, which will have corrective rallies, developing thereafter as well. It will be a larger degree corrective structure. But that is only after we complete 5 waves. Okay, so how do we complete those 5 waves? Well, let's get into the 60-minute chart now. You know what? Let me take you to the daily chart. I think the daily chart may be a little more simple to comprehend. So we'll go one step down at a time. As I noted before, I view this entire structure from the top in 2018 until we hit the bottom of March of 2020. I saw all of this as one larger degree big corrective structure. And yes, some corrective structures can hit higher market highs. This is not unusual in markets, believe it or not. It is very possible that a corrective structure can make a higher high than the prior high in the impulsive structure. And that's pretty much what the market told us here, which is why this was a crash, because corrective structures take shape as A, B, C. And those are generally the 3-wave structure. C waves are known to be crash-like. To give you an example, the crash that we experienced in 29, it was a C wave crash. For those who remember that the flash crash, as example, I think was in May of 2010. That was a C wave crash. C waves often provide us crash-like environments. This was no different than what we saw in March of 2020, which is what actually made me even more confident that the market was about to embark upon another major market trend. And that is what I'm still looking for today. Now, remember, off of this 4, which is what I'm viewing completed in March of 2020, I am looking for us to complete a 5-wave 5th. And this is broken down as waves 1, 2, 3, 4, 5. And as you can see, we are within this wave 3. Meaning the market is going to continue, in my opinion, the market is going to continue to melt up into 2022. That's my opinion. Is it going to be a straight line? No, that's not how markets work. Markets work in an up-down scenario, 5 waves up, 3 waves back. It's a process. The market is a process. It does not move in a straight line. And that will bring me to my expectations on the smaller degree. Where I expect us to be heading over the next couple of months, and for those that have read my analysis, I've explained that, we're looking at a 200 to 300 point pullback that I expect to happen. My only question is, are we going to be starting that 200 to 300 point pullback from the 4440 level, or can we extend all the way up to the 4600 level before we begin that pullback? As it stands now, my primary expectation is for us to complete to 4600 this summer. And then we get our pullback before we start the next major rally phase. For now, that is my expectation. I provided our members a 4287 support level last week to maintain that perspective. That remains our on the larger degree micro support, but that remains our support right now. We bottomed at 4289, so we held that by 2 points, and we've now started moving up to new all-time highs. As it stands today, 4287 to 4300 is our support that's going to keep the pressure higher towards 44.40 next. Depending how we develop over the next week, I will likely be moving that support higher. And as long as we continue to maintain each new level of support on pullbacks, we are going to be focusing on the 4,600 level. Should the market top out at 44.40 and then break that initial support, then I'm going to expect that 200 to 300 point pullback to have begun. And from there, you will have your next buying opportunity for the rest of the year. That's going to take us likely to 4,600 plus. Should we make it up to 4,600, then I'm looking for a pullback down to 4,300. From there, you will have your next buying opportunity to 4,700 plus into the end of the year, potentially into the first quarter of 2022. So in general, I'm giving you my smaller degree time frame expectations as well as what my larger degree time frame expectations are. The larger degree time frame expectations I know are not pretty. There are times people have called me a perma bull. There are times people have called me a perma bear. I have to be honest with you folks. I really don't care for such names. I'm not a perma anything. All I look at is, what does the market tell me based upon our analysis? Back in late 2019 and early 2020, the market was telling me that it is not healthy. In fact, at the time in February of 2020, I outlined to my members, I even think I put out a public article on this, that I was shorting the market at that point in time. And I was using the EEM, the emerging market ETF, because it provided us with the lowest risk shorting opportunity. We got a 35% short out of that. It was a beautiful setup. But at the same time, the market also said, well, now it's time to get out of the short side, and now we have to start looking to the long side. And that was probably the scariest time for anybody to be going long. I remember what the low was like in 2009. I remember quite well what the low was like in 2020. And I got to tell you, March of 2020, at least in my opinion, was a much more difficult time to buy than it was in March of 2009. In fact, when we broke down below 2,400 on the S&P 500, I remember I turned to my wife. I told her months beforehand, take out all of our children's 529 plans out of the stock market, take it all out of the stocks, put it into cash for now. I think you can only make changes in that twice a year. I told her, take it out of the market at that point and put it into cash. Leave it in cash in the 529 plan, and we'll reinvest when the pullback happens. When we broke down below 2,400 and we were crashing, I turned to my wife and I said, now is the time to start putting the kids' money back into the stock market in the 529 plans. She even looked at me and said, are you sure? So believe me, I remember it well. The fear was palpable. I was up literally some days 24 hours trying to calm people down, providing analysis of the smaller degree turns as we were coming towards that 2,200 ideal target for a bottoming. And, our larger degree structure told us we were going much higher. Our larger degree structure is still telling us we're going much higher. The problem is, once this structure completes this 5-wave structure to the upside over the next couple of years, I don't think we're heading for very pretty times. So that is the general view I have of the U.S. equity market as we stand today. I think I have another 12 minutes or so. I will gladly open the floor to questions.
Thank you, Avi. Let's go ahead and get right into it. Do you think that this market will behave like the previous markets? It moves because of the Fed influx of money. They hope that this way they can postpone a market drop.
Allow me to show you guys something. Okay, I'm going to pull up a chart. I don't know if you're going to be able to see it now because I don't know if it comes up. Let's see if we can get it up and have you guys actually see it. Where is my Fed chart? Here we go. Now, can you guys see that?
That has not changed.
It's not changed. Okay. Should I stop sharing my screen and reshare again?
Yes, please, because I'm sure they'd like to see it.
Okay, you are. screen, stop share. And now share screen. There we go. There we go. Can you guys see it now?
Yep, that's great. Thank you.
Okay. I get the question all the time, well, the Fed's standing behind the market, so we're just going to keep going up. I got to tell you, folks, I view that as wearing that type of perspective about markets is like wearing blinders. That's not the case. The Fed is unable to prevent markets from declining. Alan Greenspan has noted as such. The Fed is unable to prevent the market from declining. And I can provide you with analysis in 2007 and 8 to show you this. And all I need to do is provide you the analysis from March of 2020 for you to see it. And if you cannot see that the Fed was desperately trying to prevent or even slow this market crash, folks, they did four things before the market even bottomed. Do you think it even slowed down our 35% crash? So I'm going to warn you, the Fed cannot override market sentiment. Market sentiment, the general market, is much more powerful than the Fed. If you believe that the Fed can truly control our market, March of 2020 would not have happened, because the Fed tried desperately with trillions of dollars to stand behind the market and was unable to. So in my opinion, I just do not see the potential that the Fed will be able to stop what I see coming.
Great. Thank you so much. Now, what is your long-term expectation for interest rates, and do you have a chart?
I don't have a chart on that right now, but what I will tell you is my expectation is that we're going to be heading into something very similar to what we saw in Europe in 2010 during the debt crisis debacle there. My expectation is we're going to see a rising yield deflation, where asset prices will come crashing down. And at the same time, I think it will be coupled by a rising yield. Why that is so dangerous is because, historically, deflation has been accompanied by lowering yields. Once we go into a deflationary period, people seek some type of safe haven in bonds. So when there's an increase in demand for bonds, it drives the rates lower and lower. So most often, historically, we have seen a deflation accompanied by dropping yields. My fear, and I think that's what a lot of our analysis is showing, my fear is that we are going to be heading into a period of time where people are going to start questioning, and I would imagine it's because of how high the US government debt has now gone, and we're just spiraling out of control. My expectation is we probably will be heading into a period of time where people are now going to start questioning the US government's ability to be able to pay that back. And I think we're going to see, rather than people looking at bonds as safe havens, I think people are going to start questioning bonds a lot more. And I think we're probably going to be seeing a rising yield deflation, because the reason I also think that is because our long-term charts for bonds, big picture, similar to what I showed you on the 100-year, is topping out for bonds as well, which means bonds will now have only one way to go, and that is likely going to be down, which means rates will likely be rising. So the same perspective that is telling me that we could be heading into a major deflationary period of time after 2023 is also telling me that we could be seeing a period of rising yields during that deflationary period, which means rates are going up, bonds are going down. I do not foresee that bonds are going to be the same safe haven they have been historically.
Thank you. Now, would you suggest moving 529s again this year, or just leave it until S&P reaches your topping target in a few years?
That is an excellent question. And I get that question a lot. When I say, I'm seeing a top here, I'm expecting a 200, 300 point pullback, or I'm expecting a 500 point pullback before we go higher, or whatever it is. I get the question, well, should I sell? There is no one size fits all answer to that. A lot depends on what your risk tolerance is. Are you willing to sit through a 200 or 300 point decline? Are you willing to sit through a 400 point decline? What is your risk tolerance? As for me personally, I will probably be exiting a lot of my own positions once we complete the top of the third wave of this rally off the March 2020 low. But that's purely because of a risk tolerance, my own personal risk tolerance. It's not quite high. I'm as I near my own personal semi-retirement, I really do not have a desire to take on a lot of risk as I see a major market top looming before us in the coming years. So I may be going much more to cash in 2022 than some others would be, who are maybe 30 years old or much younger than me. I've turned 51 this year. So for me, I'm becoming much more risk conscious. Not everybody is in my position. So, a lot depends on what your risk tolerance is. My expectation is we're still going to go up to 6,000, but I think once we get north of 5,000, especially when we're hitting 5,500, I probably will forego that last 10%. That's my own personal feeling. Again, everybody is different.
So that brings us to the next question. What will be the trigger for correction in 2024 from 6,000 to 1,000 of S&P 500?
Well, I am not a prophet in that I can't tell you what the news will be, but I can assure you that there will be some news associated with it. There always is. But the problem is the news is always retrofitted to what the market does. It's not like somebody's going to tell you, well, this is going to be the news and this is what's going to happen in the market. In fact, there have been many studies that have shown you can know what the news is beforehand and still not know what the market's going to do. The news is not really important at the end of the day. It's always retrofitted. What is much more important is where we are within the sentiment, the progress of the sentiment trend. The trend is much more important than the underlying news. How many times have you guys seen markets rally on bad news and crash on good news? Do you remember back in April of 2020? I mean, I remember, you know what? I may even have that. Let me see if I can pull that up and you guys can see it. Let me pull this up because this just can you guys see that picture?
It did not change.
Oh, hold on a second. Let me let me do this again. Stop share and screen share. There we go. Can you guys see that picture now?
Perfect.
Now, that picture tells you everything you need to know about news and the market. The market at that point had already bottomed at 2,200 on the S&P. In other words, sentiment had gotten as bearish as it could. And there was only one more direction. There was only one direction the market was going to go. We reached an extreme. The market now is turning up. We then had, even though the market was turning up and it was turning up stronger than ever, we saw the beginnings of the strongest rally in our history. Yet we were getting some of the worst number of COVID deaths. We had record job losses and the market was climbing and climbing and climbing. It didn't care. So folks, what is the news going to be that's going to trigger it? I'm not a prophet. I can't tell you what the news headlines are going to be. I can tell you what the sentiment trend is going to be at the time. And the news, I can assure you, will be retrofitted. So in general, that's my answer.
Thank you. Now listen, I'm going to switch gears. Japan's debt is 2/3 of its GDP. I didn't see Japanese yen is facing any crisis. Can you explain that?
Well, it's not that we're not necessarily looking at a dollar crisis from my perspective, which is, which is what we're talking about in your case. You're bringing up, the yen. I'm not looking at a resultant dollar crisis. I'm looking at a financial market crisis. Ultimately, do I think our debt is too high? Yes. Did Japan go through a lost decade or two? Yes, they did. And I think that's where we're headed. So if you want to compare us to Japan, I think we're now going to be headed in a lost decade or two, similar to what Japan had. So that's my general answer on that question.
Great. Now, Avi, let's end this on this question. We're looking for your outlook on a few sectors. For example, we'd like to know your outlook on gold and Bitcoin, precious metals, and oil.
Okay. Precious
Oil
metal,
long term.
precious. Well, I got to tell you, when you say long term, folks, I got to tell you, I don't have a much different perspective than I do on. Excuse me one second. I don't have a much different perspective on the long term in the metals and oil and Bitcoin that I do on the market. I think we're probably going to see similar types of major topping occurring over the next several years throughout all these different types of markets. I think after the first decline that I showed you on my monthly chart, at that point, I think you may start seeing some divergences in markets. But I think the initial decline that I expect in the market, probably that I think can begin around the 2023 timeframe, I think you will probably see most markets declining along with that. However, thereafter, I think we may start seeing, as we move through the 2020s, I think we may start seeing divergences among markets. As an example, I think there is strong potential for emerging markets to outperform US equity markets after that initial decline that I think can begin in 2023. That initial decline may last a year or two to begin with, but I think thereafter you may start seeing, as an example, emerging markets begin to outperform the US equity markets. And I think we may see that in other aspects of the markets as well at the time.
Avi, thank you so much for your presentation and for joining us today.
Thank you so much for having me.